Picture this, a $2,600 rental in St. Petersburg slashed to $2,000 yet still sitting empty. It's happening across Florida, with some landlords cutting rents by a whopping 30%. What's causing this rental market meltdown, and how deep does the rabbit hole go? Remember the recent rental boom, when finding an affordable place to live seemed like winning the lottery? Well, the tables have turned. Landlords across the Sunshine State are scrambling, slashing prices left and right. It's a renter's market now, but at what cost? This sudden shift has left many scratching their heads. What's behind this drastic change? And more importantly, what does it mean for the future of Florida's real estate market? Could this be the first domino to fall in a much larger economic picture? Let's unpack this rental roller coaster and see where it might lead us. The rental market's sudden shift is just the tip of the iceberg. Beneath the surface, a seismic change is taking place. What if I told you that some of the biggest names in real estate investment are quietly heading for the exit? The reasons behind their retreat could reshape Florida's housing landscape. Before we move on, please help us spread the word by sharing this video with a friend who might like this information, and consider subscribing so you don't miss these regular updates. Thank you. Meet the corporate giants who once dominated Florida's housing market: Blackstone, Starwood Capital, and Invitation Homes. These Wall Street behemoths were once unstoppable, snatching up properties left and right, but now they're singing a different tune. Let's put this into perspective. Approximately 177,000 homes in Florida are owned by Wall Street investors. That's a staggering number, representing a significant chunk of the state's housing market. But here's where things get interesting. These same investors are now transitioning from aggressive home buying to becoming net sellers. Take Blackstone, for instance. They're currently listing properties at a loss. Imagine buying a home for $365,000, only to turn around and list it for $350,000. It's not just a one-off situation, it's a trend that's sending shockwaves through the industry. Why would these savvy investors accept such losses? The answer lies in their strategy. These corporate landlords are aiming to exit before prices drop even further. It's like they're playing a high-stakes game of musical chairs, and they don't want to be left standing when the music stops. But it's not just about selling at a loss. Some landlords are resorting to desperate measures. There are reports of cash-for-keys strategies, where landlords are actually paying tenants to leave instead of facing the lengthy and costly eviction process. It's a clear sign of the challenges these corporate landlords face in maintaining occupancy. The implications of this shift are far-reaching. As one industry insider put it, these Wall Street investors don't want you to know that they're starting to sell. They want to be one of the first to the door to still sell at a decent price. It's a race against time, with each player trying to outmaneuver the others. But why the sudden change of heart? The answer lies in the harsh reality of the current market. As another expert bluntly stated, the harsh reality is setting in. Americans and renters can't afford these rents anymore. It's a simple equation. When renters can't buy, properties sit vacant and landlords lose money. This selling trend among corporate landlords like Blackstone and Starwood Capital isn't just a blip on the radar. It could be an early indicator of a broader market downturn. Think of it as the canary in the coal mine, warning us of potential danger ahead. The question now is, what does this mean for the average homeowner or potential buyer in Florida? As these corporate giants offload their properties, will it lead to a flood of homes on the market? Could this potentially drive down prices, making home ownership more accessible? Or is it a sign of tougher times ahead for the entire real estate market? As big investors flee, local landlords face a perfect storm. Imagine watching your property taxes jump to $5,100 a year while your tenants struggle to make rent. It's happening across Florida, but how long can this tug-of-war between rising costs and stagnant incomes last before something breaks? The reality for Florida landlords is becoming increasingly grim. On one side, they're grappling with skyrocketing property taxes and insurance costs. On the other, they're facing a tenant base that simply can't afford to keep up with rising rents. It's a classic case of an unstoppable force meeting an immovable object, and the result is a market teetering on the edge. Let's break down this financial squeeze. Property taxes in Florida are soaring to unprecedented levels. We're seeing cases where annual tax bills have shot up to $5,000, and that's just the beginning. Experts predict these costs will continue to climb as property values increase. Add to this the rising insurance premiums, and you've got a recipe for financial strain on landlords. But here's where it gets tricky. You might think landlords could simply pass these costs on to tenants through higher rents. After all, that's how it's worked in the past, right? Not so fast. We're witnessing a severe affordability crisis among renters in Florida. Many households are already spending between 30 to 50% of their gross income on rent. In Miami-Dade County, the situation is even more dire, with the rent-to-income ratio hitting a staggering 45%. These aren't just statistics. They represent real people struggling to keep a roof over their heads. When nearly half of your income goes to rent, there's little left for other necessities, let alone savings or emergencies. It's a precarious situation that's pushing many renters to their financial limits. So what happens when landlords need to raise rents to cover their increasing costs, but tenants simply can't afford to pay more? We're seeing the answer play out across Florida right now. Properties are sitting vacant. Landlords are facing negative cash flow, watching their investments turn from profitable ventures into money pits. This creates a lose-lose situation. Landlords can't fill their properties without lowering rents, but lowering rents means they can't cover their rising costs. Tenants, meanwhile, are priced out of homes they desperately need. It's a vicious cycle that's eroding the foundations of Florida's rental market. The implications of this trend are far-reaching. As more properties sit vacant, we could see a ripple effect throughout the local economy. Reduced rental income means less money circulating in communities. It could lead to decreased property maintenance, affecting neighborhood quality. And if landlords start defaulting on mortgages, we might be looking at a new wave of foreclosures. But perhaps the most concerning aspect of this situation is its potential to escalate. If property taxes and insurance costs continue to rise while wages remain stagnant, we could see an even more severe affordability crisis. This could lead to increased homelessness, overcrowding as families double up to afford rent, or an exodus of workers from expensive areas, potentially disrupting local economies. Have you noticed how today's Florida real estate market feels like deja vu? There's a reason for that uneasy feeling in your gut, and it's hidden in the data from nearly 2 decades ago. As we dig deeper into the current state of Florida's housing market, we're uncovering some startling parallels to a period that many would rather forget, the lead up to the 2008 housing crisis. Let's rewind to 2005. Investor purchases in Florida peaked, creating a frenzy in the real estate market. Fast forward to today, and we're seeing a similar pattern unfold. But here's the kicker. Just like back then, these purchases are now on a steep decline. It's as if history is replaying itself frame by frame. But it's not just about who's buying, it's also about what they're paying. Currently, median list prices in various Florida zip codes have taken a nosedive, dropping by 5 to 10%. To put that into perspective, imagine you bought a home for $300,000 last year. Today, you might be looking at a value closer to $270,000 or even less. That's a huge dip that's reminiscent of the early stages of the last housing crash. Now, you might be thinking, surely it's just the residential market that's affected, right? Wrong. The commercial real estate sector is also showing signs of distress. We're seeing properties being offloaded at significant discounts. For instance, a recent sale of an apartment building went through at a 20% markdown from its 2021 purchase price. That's not just a minor adjustment, it's a clear sign that investors are bracing for impact. And here's where it gets really interesting. Remember how in 2008, the big players seemed to vanish right before everything went south? Well, history has a funny way of repeating itself. As one industry insider put it, the big Wall Street guys are starting to sell silently. They want to be one of the first to the door to still sell at a decent price. It's like watching a high-stakes game of musical chairs where no one wants to be left standing when the music stops. This exodus of major investors isn't just about protecting their bottom line. It's a canary in the coal mine, warning us of potential trouble ahead. These corporations have teams of analysts poring over market data day and night. When they start heading for the exits, it's not a decision made lightly. So what does this all mean for the average homeowner or potential buyer in Florida? Well, it's a double-edged sword. On one hand, we might see housing become more affordable as prices continue to drop. That's good news for those who've been priced out of the market. On the other hand, if you're a current homeowner or looking to sell soon, you might be in for a bumpy ride. But let's not jump to conclusions just yet. While the parallels to 2008 are striking, it's important to remember that no two economic situations are exactly alike. The regulatory landscape has changed, and lenders are generally more cautious now. However, that doesn't mean we're out of the woods. Just when you thought the real estate game was over, the rules are changing. What if the key to thriving in this market isn't about location, but about a completely different factor that most investors overlook? The answer might surprise you, and it's hiding in plain sight. As Florida's rental market cools and big players exit, smart investors are shifting their focus to more promising territories. The Midwest and Deep South are emerging as unexpected hotspots, offering higher cap rates and lower rent-to-income ratios. These regions present opportunities that savvy investors can't afford to ignore. Take Alabama, for instance. Property tax bills there can be as low as $1,000 a year. That's a significant cost advantage that can boost your bottom line. Or consider West Virginia, where cap rates of 8 to 9% in many markets are turning heads. Even with its economic challenges, West Virginia offers returns that are hard to match in more competitive markets. Oklahoma is another state catching the eye of informed investors. Cities like Oklahoma City and Tulsa are showing promising returns. However, it's crucial to factor in higher insurance costs due to tornado risks. This highlights a key principle in today's market. Thorough analysis is non-negotiable. In this shifting landscape, the mantra for success is clear. Ensure your property's cash flow from day one. Gone are the days of relying on future appreciation to turn a profit. Today's market demands a more calculated approach. You need to factor in all expenses, vacancy rates, property taxes, insurance, and maintenance to determine your true net cash flow. But how can you access all this data without spending countless hours on research? This is where technology comes to the rescue. Rent analysis apps have become indispensable tools for modern investors. These apps provide crucial data on rental rates, cap rates, and vacancy rates, allowing you to make informed decisions quickly and efficiently. One of the most critical factors in today's market is affordability for tenants. As we've seen in Florida, when renters can't afford the rent, properties sit vacant and landlords lose money. That's why it's crucial to focus on markets where tenants can comfortably afford the rent. This approach not only ensures a steady cash flow, but also reduces the risk of vacancies and evictions. Remember, the key to thriving in this changing market isn't just about finding the right location. It's about adopting a holistic approach that considers all factors affecting your investment. This means looking beyond traditional hotspots and being open to opportunities in unexpected places. The current market conditions present both challenges and opportunities. While some investors might be tempted to retreat, those who adapt their strategies and leverage the right tools can find success. The key is to stay informed, be willing to explore new markets, and always prioritize cash flow over speculation. As you navigate this shifting landscape, keep in mind that real estate investing is not a one-size-fits-all endeavor. What works in one market might not work in another. That's why it's crucial to do your due diligence, use available tools to your advantage, and be ready to pivot when necessary. As we've seen, Florida's rental market is showing clear signs of distress. From plummeting rents to corporate landlords rushing for the exits, the writing's on the wall. But what does this mean for you? If you're an investor, it's time to reassess your strategy. The days of easy profits in Florida's real estate market might be over, but remember, every challenge brings opportunity. Maybe it's time to look beyond the Sunshine State. Places like Alabama, West Virginia, and Oklahoma are offering surprisingly attractive returns. For potential home buyers, this could be your chance. As prices drop, that dream home might finally be within reach. But tread carefully. The market's still unpredictable. One thing's clear, knowledge is power in this shifting landscape. Stay informed, adapt your approach, and you might just turn this market turbulence into your advantage. After all, fortunes are often made in times of change. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.